They always like distance so that you do not understand that their policy over here is having this impact over here. This system is so fragile that holding your wealth in there is so dangerous. They want you to think that this is an old relic. Why are they buying it hand over fist? Why have they never been able to duplicate it in a lab? Silver as well. There's a finite amount of this. As you have seen, there's an unlimited amount of that. It's easy to create new. It's easy. They just have to push a button and they can create as much as that as they want. But what happens is that whatever is already out there goes away. It loses more and more value until we hit zero. Please tell me why nobody talks about that. But the reality is we're at endgame and we've got so many things in place that can push us over. Central banks recognizing the revaluation potential of gold. So central banks have what's called a revaluation account where gold is revalued on a regular basis based upon their initial cost and the current inflated value of it. But this is the tool that they will use to do that overnight revaluation, where they take this garbage that has absolutely no value. Yes, you can still buy stuff with it right now, but that is only because people still trust it. They grew up with the dollar, or I don't care what country you're in that currency, right? And what did they know? They knew that people marry the legal money of the state. So don't change the name, just change what backs it. Just change what it is. Okay, well, that's what I think about that. But they take this that has no intrinsic value, used only in one place, and they revalue it against gold, which is used in every single area of the global economy, period, end of discussion. Does not require a government to say this is legal tender. It is money for thousands and thousands and thousands of years. That's how the overnight revaluation occurs. That's when they lop off those zeros, and whatever you have in the system, I don't know how much that revaluation is going to be, but typically it's about 1,000 to 1. So you go to bed at night, you have $1,000. When you wake up in the morning, you have one. In the meantime, spot gold, the contract gold, right, has gone up 1,000 times, 3,000 times, whatever that number is going to be. What in the world do you want to be holding when that happens? Because it will happen. It is inevitable with everything that's happening. And with banks buying more gold than they ever have historically, they're preparing for the revaluation, period. After it became apparent what was happening twice, not once, even though that's all that they seem to talk about in here, but they raised the rates on the emergency loan program to stop the arbitrage, which, by the way, ends on March 11th. So they knew for a long time that they knew when they first kicked that program off that was what was going to happen, and they saw it happening again, and they waited until just recently to turn that free money spigot off. Okie doke. But they're going to see higher borrowing rates effective immediately, but of course that will not impact all of the loans that they gave out during that other period of time. And shocker that the use of the Fed Term Funding Program is at a record high before they close the spigot. It's amazing. And now it can be no lower than that of reserve balances in effect on the day that the loan is made. But the loan is for a year. So wherever that is, yeah, those that already got in on that free money trade, until those rates come down, they're still making free money, hand over fist. It doesn't surprise me, given the negative press and the very real arbitrage, which is those difference in rates for the free money, that presented itself. So of course they had to stop that, because the appearance of the Fed giving banks free money is not a good look, even though that is exactly what's happened and intended.
Understanding the importance of gold and silver in today's financial landscape is critical. Lynette Zang, a seasoned market analyst, sheds light on why these metals are more relevant than ever. The current financial system is incredibly fragile, and holding wealth in fiat currencies within this system is fraught with risk. Despite the narrative that gold is an outdated relic, central banks are buying it in large quantities. This contradiction should prompt investors to ask why. Central banks are aware of gold's revaluation potential. They maintain revaluation accounts where gold's value is periodically adjusted based on its initial cost and current market value. This mechanism allows for an overnight revaluation of gold, transforming fiat currency, which holds no intrinsic value, into a valuable asset backed by something real. The ease with which fiat currencies can be created is one of their greatest weaknesses. The more money is printed, the less value existing currency holds, leading to inflation and potential collapse. The process of revaluation involves significantly increasing the value of gold relative to fiat currencies. Historically, such revaluations have been substantial. For example, during the Great Depression, gold was revalued by 40% when President Roosevelt confiscated gold and devalued the dollar. A similar revaluation today could see gold's value increase by 1,000 to 3,000 times its current price. This would dramatically reduce the value of fiat currencies and highlight the importance of holding gold. Lynette Zang points out that despite negative press surrounding gold, central banks are buying it in unprecedented quantities. This contradiction should prompt investors to question the mainstream narrative. If gold were truly an obsolete asset, why would the most financially sophisticated institutions in the world be hoarding it? The answer lies in gold's intrinsic value, which cannot be duplicated or manufactured. Silver, too, shares this unique characteristic. There is a finite amount of these metals, making them a reliable store of value. Holding wealth in fiat currencies within the current financial system is dangerous due to inherent risks and potential for loss of value. On the other hand, holding physical gold and silver offers security and stability. These metals are tangible assets that can withstand economic turmoil and inflationary pressures. When fiat currencies lose their value, gold and silver tend to rise, providing a hedge against financial instability. Central banks have been strategically accumulating gold, anticipating a revaluation that could dramatically shift the financial landscape. This revaluation will be a tool to address the devaluation of fiat currencies. Gold has been money for thousands of years, used in every area of the global economy. It doesn't require a government to declare it legal tender. Its value is inherent and universally recognized. This characteristic makes gold the ideal asset to revalue fiat currencies against, providing a stable foundation for the financial system. The process of revaluation involves significantly increasing the value of gold relative to fiat currencies. Historically, such revaluations have been substantial. For example, during the Great Depression, gold was revalued by 40% when President Roosevelt confiscated gold and devalued the dollar. A similar revaluation today could see gold's value increase by 1,000 to 3,000 times its current price. This would dramatically reduce the value of fiat currencies and highlight the importance of holding gold. In the meantime, central banks continue to accumulate gold, preparing for the inevitable revaluation. The volume of gold transactions on exchanges like the COMEX and the Shanghai Gold Exchange has surged, reflecting growing demand. This accumulation is not limited to gold. Silver, too, is seeing increased demand and withdrawals from the market. The finite supply of these metals makes them increasingly valuable as more entities recognize their importance. For individual investors, this trend underscores the necessity of holding physical gold and silver. Unlike fiat currencies, which can be devalued through inflation and monetary policy, gold and silver maintain their value over time. Investing in these metals provides a hedge against economic instability and protects wealth from the devaluation of fiat currencies.
They know that this problem hasn't gone away. Even though they make it look like it did, it's not. It's infiltrated throughout every single bank. The OCC, which is the Office of the Comptroller of the Currency, you know I use their stuff all the time, particularly about the derivatives in the FDIC-insured banks, says that his agency, the Fed, and the FDIC are crafting a plan because right now, when the banks use that discount window, it makes them look bad. bad. So they want to change the rule and also change the image. The bid to change rules affecting discount window borrowing and bank liquidity requirements follows last July's sweeping proposal to require many banks to hold more capital to help them withstand a crisis. And of course, the banks are fighting that. Of course they are. So, why should they ever hold it? Aren't we in an ample reserve regime where the central bank will just come in and have their back? They seem to have done that last March and April. They always like distance so that you do not understand that their policy over here is having this impact over here. This system is so fragile that holding your wealth in there is so dangerous. But if you have physical gold and silver, you hold it and you own it outright. Because all we ever really see is just the tip of the iceberg. It's really all of those derivative contracts that are written against this that are impossible to ferret out because that is such an opaque market. But we've talked quite a bit about securitization and how everything has been turned into a trading product for Wall Street. So let's take a look at a few of those levels. This is by far not all of them. But student loans, 1.7 trillion, plus all the bets on top of that. Auto loans, 1.57 trillion. Again, we aren't seeing all the bets against this. Consumer credit, 5 trillion. And all those bets above it put it well into the quadrillion. And by the way, as a little reminder, these gray bars are crisis or official recessions. So what is always the answer to a recession? Inflation, more debt, more currency devaluation. And all of these are turned into packages and sold to you, the public, through your 401k, through your pensions, through mutual funds, through oh so many things. And you're the one that's taking the risk. But hey, if everything implodes, who are you going to talk to? If all your wealth is held in the system, who are you going to talk to? When will this end? Why can't they just keep doing it forever? Well, they'll do it until enough risk has been transferred. Once enough risk has been transferred to the public, that's when this game ends.
As the global financial system becomes more unstable, the strategic importance of gold and silver becomes clearer. The massive accumulation of debt by governments worldwide is unsustainable. In the United States, for example, the national debt is approaching $200 trillion, with additional unfunded liabilities in Medicare, Social Security, and military pensions. This level of debt is unsustainable and indicates an impending financial crisis. The continuous creation of money by central banks to fund government spending devalues existing currency, leading to inflation. Inflation erodes the purchasing power of money, making it more expensive for individuals to buy goods and services. In this context, gold and silver become essential for preserving wealth. These metals are not subject to the same inflationary pressures as fiat currencies, making them reliable stores of value. Lynette Zang highlights the revaluation account mechanism used by central banks to manage their gold reserves. This mechanism allows central banks to adjust the value of gold on their balance sheets, reflecting its true market value. This process is crucial for maintaining financial stability, especially in times of economic uncertainty. By revaluing gold, central banks can stabilize their balance sheets and provide a solid foundation for their currencies. The revaluation of gold is not just a theoretical concept. It is a practical tool that central banks are likely to use in the near future. As the value of fiat currencies declines, the value of gold will increase, providing a hedge against inflation and economic instability. This revaluation will have significant implications for investors, making gold an even more attractive asset. Silver, often referred to as poor man's gold, also plays a crucial role in this context. Silver has significant industrial applications, making it a valuable commodity. As demand for green technologies and electronic devices increases, so does the demand for silver. This dual role as both a precious metal and an industrial commodity makes silver an excellent investment. Investors should consider diversifying their portfolios to include physical gold and silver. These metals provide a hedge against inflation and economic instability, preserving wealth in times of financial crisis. Unlike fiat currencies, which can be devalued through inflationary policies, gold and silver maintain their value over time. In addition to holding physical metals, investors can explore other forms of investment, such as mining stocks and ETFs. However, it is essential to approach these investments with caution. While mining stocks can offer significant returns, they are also subject to market volatility and operational risks. Physical gold and silver, on the other hand, provide a tangible asset that can be securely held. The geopolitical landscape also plays a crucial role in the value of gold and silver. The weaponization of the dollar, where the U.S. restricts access to its currency for political reasons, has led many countries to seek alternatives. This has driven demand for gold and silver, as these metals provide a reliable store of value without counterparty risk. As geopolitical tensions rise, the importance of holding these metals increases. For example, China's increasing demand for gold is a strategic move to reduce its reliance on the U.S. dollar. By accumulating gold, China can safeguard its economy against the devaluation of the dollar and enhance its financial stability. This trend is not limited to China. Many countries are following suit, recognizing the importance of gold in maintaining economic stability. In conclusion, the strategic value of gold and silver cannot be overstated. These metals provide a hedge against inflation, economic instability, and geopolitical risks. As the global financial system becomes more fragile, the importance of holding physical gold and silver increases. Investors should diversify their portfolios to include these metals, protecting their wealth from the devaluation of fiat currencies. Understanding these global trends and positioning oneself accordingly is crucial for achieving long-term financial stability. For our American and allied viewers, the actions of central banks worldwide in accumulating and repatriating gold should be a wake-up call. The diminishing trust in fiat currencies and the strategic move towards gold highlight the need for individuals to protect their wealth. Investing in physical gold and silver is not just a hedge against inflation, but a safeguard against economic and geopolitical instability. Don't wait for the crisis to hit. Start securing your financial future today.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.